We're back with another episode of Taking Inventory. This week, we've got Nik Milanović joining the pod. Nik is the general partner of the Fintech Fund. He's the editor-in-chief and founder of Fintech Weekly. He's been at Google Pay, Pedal, Funding Circle, basically been everywhere in fintech. Nik, we're super excited to have you here, giving us basically just a state of play of what's going on in fintech. So thank you so much for joining us.
Yeah, Dan, James, thanks so much for having me. I really appreciate you inviting me onto the show and excited for the conversation.
Yeah. So why don't we just dive right in and for us and for listeners, can you just maybe level set what is happening in fintech? When people talk about fintech, what does that actually mean? Because I think there's a lot of preconceived notions. So maybe just level set there.
That's a good question because nobody agrees on the answer. And I think a lot of people kind of have outdated information on that question. So like a lot of people, I think about tech in terms of S-curves or hype cycles. Carlota Perez, who's a professor, came out with this concept of the tech S-curve, where you have an early period where a few people are hacking around and build something, and then all of a sudden it catches fire and reaches a tipping point, and all of a sudden everybody wants to build that thing and it gets overhyped. And then you have a stall out where a lot of the early promise, a lot of the reality doesn't meet the early promise, and a lot of people get disillusioned and leave. And then you have kind of slow, gradual growth where things start turning around, and the people who stick around and really care figure out the fundamentals and actually start to deliver on that long-term promise. And if you look at a lot of tech over the last decade, big data, crypto, possibly AI, you see similar dynamics. Everybody gets really excited. Well, look, first people were working on it and nobody cares. Then all of a sudden everybody gets really excited. Then enthusiasm cools off a little bit and some of the early projects say, hey, we're actually not able to do this as quickly as we thought we could. And then you get the real innovation and the real promise where people kind of right the ship. And so this is a long way of saying, I think that we're in that stage right now for fintech, where it got really hot a couple of years ago. There were a lot of new fintech companies. One out of every 5 Y Combinator founders was building a fintech company in 2021. And then the rubber hit the road. A lot of companies were mismanaged. A lot of companies raised too much money. A lot of companies hired too quickly. Some of them didn't really find product market fit. And so the last 2 years have been everybody just kind of gritting their teeth and fighting through the disillusionment part of that phase. And now we're finally starting to see news that shows that we're kind of back to the part of the cycle where companies are delivering. Nubank in Brazil announced that they had 100 million customers. Affirm beat the top level earnings expectations. Monzo raised a 400 million pound round and then extended it to include 2 more investors for 500 million. So the founders who were able to right the ship over the last couple of years are starting to really deliver on that. And that's kind of where I think we are today.
It's interesting because we follow the space pretty closely, not experts, but we kind of Twitter voyeurs on what's going on. And it does feel like there's this, we're kind of in that turning point where there's definitely a group of these businesses that seem like, at least from the outside, that they are on a great trajectory, like Mercury, Ramp, to some extent, Chime. I feel like we only read good things about these businesses right now. And then you have stuff around Synapse and Unit that is maybe less just positive. Is that a function of different business models? Is that a function of different kind of capital stacks? What do you attribute kind of the breakdown of that right now to?
It's a good question, and there's no one size fits all answer. There are some categories or business models where you have really strong founding teams that are doing things the right way and leveraging good fundamentals. And so you'll have one company in a category perform really well and another category in a company completely fail. And that usually comes down to team approach and a little bit of luck, honestly, with landing early customers or the right investors. And then you'll have other entire subcategories where it's just Armageddon and none of the products work out. And I think you have a little bit of both in fintech today. I won't name any names, but you have companies that raised too much money and promised product market fit that wasn't there and weren't able to pull the rabbit out of the hat and really deliver on that. And some of those founders said, hey, we're going to shut things down, get back to basics, understand what we're doing that works, and then test and learn, and have actually turned the ship around and built strong companies. And some founders have just said, look, we were here to build a company when it was easy to raise money, and I was getting invited to all the conferences to speak, and Forbes put me on their cover. But now that it's not fun anymore, I think I'm out. And so I had a boss back in the day who said, when the tide goes out, everybody will see who was swimming naked. And I think the tide's gone out right now most of the way, but there's probably still a couple companies in there that, are running out of time to really figure out, what they're going to do and what they're going to build. And so I think we kind of have to get past this phase to really establish some credibility in fintech again.
And, a few years ago, as you mentioned, when there was so much money being raised by fintechs and 1 in 5 companies at Y Combinator, I can't think of probably a more heavily regulated industry than finance, and one that doesn't easily translate market to market. Certainly state to state is challenging, but once you cross an international border, like, EU has different regulation, Brazil has different regulation. And so that to me seems like that would be so challenging and almost like something to stop you from going into that market and maybe choose an easier path. Like, how have companies jumped in, fought some of those regulations, or maybe circumvented some in some instances, and continued to grow, the ones that are successful anyway?
Yeah, it's a good point. And I think that's something that's so different about fintech than a lot of other product areas. If you look at like consumer internet, or if you look at e-commerce, if you look at advertising, you can have a pretty comparable product in many different countries, and you're just, modifying details like, language, currency, sales tax. With fintech, you have to have a fundamentally different product in a lot of different regulatory regimes. And so it's really hard to scale across borders. And I think that was one of the toughest lessons of the first wave of fintech. Was a lot of companies grew quickly and then raised their Series C and said, now we're going to expand internationally, and just totally got annihilated when they tried to do that. Regulators, I think, have been really proactive in a lot of countries at saying, okay, we need to adjust the rules to accommodate digital financial technologies. In others, they've kind of fought tooth and nail to protect the legacy banking industry. And so it really, varies country by country where you can build a fintech successfully or where you're going to get a lot of regulatory pushback. In the US, I think it's been kind of a mixed reception. Regulators have taken a hands-off approach in some areas and come down, pretty heavily in others. And I think, one of the things that you mentioned is because is dead on, and it's because a lot of fintech founders, look at fintech as a way to pursue regulatory arbitrage. So you'll have a fintech company that's effectively registering all of its loans in a state where the cap on the rate that you can charge on a loan is 36%, and then making those loans to consumers online living in another state where the cap on loans is 20%. And let's say, okay, because the loans were originated in the state where we're based, we're not subject to this state's terms. And that's just one example of many where, you can have arbitrage in a way that's elegant and works, and everybody comes out better. And you can have arbitrage in a way that kind of irritates regulators. And so I think as a fintech founder, a lot of people don't realize, like, you really have to be in lockstep with whoever your prudential regulator or your bank's prudential regulator is, because that's a big tail risk to avoid getting shut down. And if you're expanding internationally, you have to know what the rules and the playbook look like before you actually make that decision. And so it pains me inside when I see a company in Europe raise a lot of money and say, okay, now we're going to expand to the US. Because expanding to the US is like expanding to 50 different countries at the same time. You have state-by-state rules and regulations for money transmitters, for lenders. I just think it's a decision that you really have to think through in fintech a lot more than some other areas.
Is it? I wouldn't usually think about like the U.S. as being like sort of the complicated market in comparison to like somewhere like the EU, and that comes, given that we're just always been more in the ad space, you have like just a lot of privacy regulations coming from the EU, so they become kind of the pain of the two. Is that not the case when it comes to fintech? Like, is the EU more consistent versus a bunch of different states?
The EU, and like they say this themselves, they pride themselves on being regulatory forward, which, for better or for worse, they're always proactive about new rules and regulations. I think that benefits fintechs sometimes. Like open banking regulation really helped a lot of fintechs in the UK and the EU with accessing financial data. And it took a while for that to happen in the US. Because Europe is proactive in putting together regulations that fintechs could leverage to be able to offer products compliantly. But generally, I feel like the US is a little bit more hands off, or the US's approach is, hey, don't break anything and we won't come down on you hard. But when we see things starting to break, when we see people, falling for scams online, when we see people flouting rules, that's when we're going to come and really start enforcement. And so it just totally depends on like who's in the top seat at the regulator. And it'll switch with each administration where you have a director, go out who is super light on fintech and a new director come in who comes down really hard on fintech. And so I think it's a matter of kind of reading the tea leaves and understanding, what the prerogative of that administration is and of that director is to understand, how you need to adjust your strategy accordingly.
And, talking a little bit internationally, but changing gears a bit, you started This Week in Fintech a number of years ago, have grown that community to over 100,000 subscribers, at least last kind of reported. You're kind of very vocal about building these communities across the globe, these fintech communities, and bringing builders and proponents together. And then you've since parlayed that into the Fintech Fund. And so can we get a bit into your origin story of like why you started this newsletter and how did it end up getting to this fund that you now run?
I mean, I ask myself why I started this all the time. I still remember when the newsletter crossed 100 readers, and I was amazed. I thought it was incredible. I didn't know there were 100 people who cared about what I had to say. I remember telling my mom that it had crossed 100 readers, and she couldn't believe it. And now we're at I think we just crossed 107,000 subscribers last week. And we have about 9,000 in our online community, and we've had about 50,000 people come through our events over the last couple of years. But I think that the opportunities in financial services are a lot more interesting when it comes to new tech in a lot of other countries outside of the US and Europe. And that's mostly a feature of how developed that market is for financial services. You have a lot of countries where there are just fewer banks. And there's not a unified payments infrastructure, and there are not deep capital markets for lending or securitization. So you basically have like a small sliver of the population that are able to get access to financial services, and everybody else who just kind of deals with the informal versions, whether it's like payday lenders or social saving circles. And so you see something like Nubank, and it's really transformative because in the U.S. you have a neobank like Chime, and they're effectively going head to head with JP Morgan for the primary banking relationship. And they're able to offer some features that are, better and haven't been seen before. Get your paycheck a couple days early, automatically file your taxes, get a secured card online. But it's not like a huge step function difference from what JP Morgan's already offering most people. And so you haven't seen like that mass migration over to Chime from JP Morgan yet. In Brazil, you have 60 million people who were not able to get any kind of credit and all of a sudden could access credit on their phone. And that was a transformative impact for Nubank. And so Nubank just passed 100 million, total users because they just built a banking product for most of the population that nobody had access to before. And I think that there are so many markets out there like that, where you just build one, winning payments product, and you basically have like the entire market at your disposal to keep launching banking products. And so we have some investments that kind of follow those lines. You see other big winners like Tinkoff in Russia, Kaspi in Kazakhstan, who like nobody really covers or knows about outside of the fintech world. But if you're in fintech, you're like, oh, these are all multi-billion-dollar companies. And so that's what I think is so interesting about international fintech is different countries, different problems, but some of those problems are legitimately much bigger to tackle for tech companies.
Crazy. And how big is the fund now? And like, when did you start it? And like, how many investments have you made? I don't know if you can share all that stuff.
No, it's all good. It's tiny. It's the world's tiniest fund. I call it craft VC. It's like small, homegrown, microbrew, fund out of my garage. So fund one was $10 million. Fund two, we're not done raising it yet, but it'll probably be another 10 million. We have 8.5 million raised so far of a 10 target. And so I'm just investing in the pre-seed and seed, where you're really taking bets on teams and vision more than anything else. But it's because that was a lot of my background at Pedal, at Funding Circle, when I joined as the first employee. The early years could be a little bit chaotic. And so I love working with founders who are going through that, because I think it's helpful to just have somebody else who can say, hey, what you're experiencing is totally normal. There's a lot of ups and downs, but I believe in you, and we'll get you where you need to be going.
And some of your investments, it looks like, are also in kind of blockchain, DeFi. Are you guys still making those types of investments? Like, can we talk a little bit about your thesis and your vision for what DeFi does for the broader ecosystem?
Yeah. Oh my God. That's a that's a whole thing worse. Um, so I was just talking to somebody the other day about fund managers who are subject matter experts. And in theory, if you say I want exposure to healthcare tech, or I want exposure to fintech, or I want exposure to ad tech and marketing tech, you want to find an investor who knows that space cold, and they know who the good players are, they know who the bad players are, they know what's an interesting idea, they know what's a bad idea. But the problem is, the more expertise you develop, the more you kind of get set into a certain set of viewpoints. And so I think the best investors are people who can, one, become experts, but two, are always curious to learn and always want to be proven wrong and keep learning. Because I think in tech, as soon as you have consensus around something, that consensus becomes wrong, and somebody proves that actually the reverse is true. And this always happens. As soon as there's like a dominant narrative, it means that narrative is out of date, and somebody's going to prove you wrong, and there's going to be a new narrative, which is what's so exciting about tech. Like, we always figure new things out. And so this is a very, very long way of coming back to blockchain and crypto. But basically, I think if you're looking at products that are going to scale today and find interesting use cases in financial services today, it's a lot of this like fintech 1.0, where it's conventional infrastructure but better UI. Eventually, I think that more tech companies are going to offer better financial services infrastructure. Like right now, we're kind of it's like right now we're sending emails where when you write the email and hit send, it actually goes by fax machine to the person on the other side, and then the fax machine converts that back into an email, and that's what they see. That's kind of how fintech is working today. What you really want to set up is fully digital rails, where if you send an email, it just goes and gets sent to the person on the other side instantly without having to get converted to a fax and converted out of a fax first. And so that, in my mind, is a little bit more of what you think about when you think about blockchain and when you think about crypto and you think about DeFi. It's programmable money built as a completely new rail in a way that you can do a lot of things that you just can't do conventionally in financial services, like have fully pre-programmed auditable loan contracts between two parties that don't require an intermediary, or have rich messaging built into each transaction that you can't do today. And so I think in the future, a lot of fintech is going to move towards crypto and towards decentralized rails and towards blockchains, but we're not there yet. And the problem is, in the meantime, there's been so much noise where people have kind of built overhyped projects and then sold out, and then people have become disillusioned. And so this is my very, very long way of saying we're still investing in some crypto and some blockchain and some DeFi, but we're taking it very slowly. And we're trying to figure out products that actually have like real use cases today, knowing that eventually a lot of fintech is probably going to move in that direction.
And do you think the catalyst, like, for just like broader adoption, like, would it be like the ETH ETF, or is it like a new administration? Like, is so much around it right now, just like the uncertainty of how like the federal government views it, or is it really like the tech isn't there yet?
I think it's like the early days of the internet. A lot of the tech, is there, but the core set of crypto users are like people who are hosting their own servers for websites in the early days of the internet. It's like very libertarian and very like, we want to get outside of the system and like build our own system from the ground up, which is kind of how like ham radio operators or early website developers looked, before you had domain registrars like GoDaddy available, or cloud hosting for building new websites. And eventually, like these larger infrastructure providers are going to come online that make crypto a lot more accessible to everybody, is the theory. And kind of like the internet, it'll go from being this kind of like niche category of products for super users to products that are actually more accessible and easily available and easy to use for broader consumer bases. But that leap hasn't happened yet. And I think you're starting to see like the very, very, very early innings of that happening. The Bitcoin and the ETH ETFs are interesting, but those kind of like pattern match to like 90% of crypto, which is just built around use cases that have to do with speculation, like holding coins and watching them go up or down. Like NFTs were kind of built around speculation, individual chains, ICOs, all kind of built around like speculating on whether these currencies would go up or down. But now you're starting to see real volume move through stable coins. And there's really like no speculative element of stable coins. It's as boring as it gets. You buy one USDC for $1 and you hold on to it and the price doesn't change. But what's interesting is you see businesses making payments to their vendors throughout their supply chain using stablecoins. You see people sending peer-to-peer transactions from one country to another and avoiding the 8 or the 15 or the 20% fee that they normally be charged for cross-border transactions. And so I think stablecoins are showing that there actually is, one first big scaled killer use case coming out of crypto. And my hope is that that's going to be a watershed that actually opens some other big consumer use cases where if I'm using a money transfer app to send money back home to, wherever my family is, I don't even have to know that it's crypto on the back end. All I know is that it moves instantly and it costs almost nothing, but it just happens to be built on top of stablecoins instead of on top of Western Union or whatever else it is.
And is that typically, my understanding is like the main use case is that's usually backed by dollars. Like, is that going to be the thing that gets like the U.S. government excited about like crypto maybe, or is that like wishful thinking?
It's so hard to read. And it's going to vary by administration. A lot of countries are looking into launching central bank digital currencies, what they call CBDCs, where they basically just digitize their own currency like the dollar, in order to make it interoperable. And a lot of crypto people are against CBDCs because this would give governments control over where their money can be spent, and it gives them full visibility into who's moving money and how much and in what direction. And so it's like introducing surveillance on a dollar. It could lead to a decrease in economic liberties. But that seems to be the direction that a lot of governments are kind of taking the adoption of stablecoins. There's some pushback about private stablecoin operators like Circle or Tether being able to operate, but I think that they're providing enough of a real valuable service that my strong bet is that the U.S. government comes around to stablecoin operators and providers being regulated financial entities. And so I think Circle is going to be okay in that regard. And I think that there will be a lot of people who start building really interesting applications that are on top of stablecoins. Like as one example, we have an investment in a crypto company in Argentina. And what they initially built was the largest Argentine crypto exchange. It's called Let's Bit. And what they found was that a lot of users were signing on to the exchange and they weren't actively trading. They were just taking Argentine pesos and they were buying USDC and they were just letting it sit in their accounts. And so they were talking to users and saying, hey, like, do you want to trade? Do you want to speculate? Like, why are you just buying a bunch of USDC and letting it sit? And all the users said, look, the peso fluctuates so much day to day. Our currency keeps getting devalued. All I want to do is be able to earn, like, get my paycheck, convert it into dollars, and just hold it in dollars so that the value of my money isn't dropping overnight. And so they had an insight and said, okay, this is actually a way more interesting product. And so they built personal banking based entirely on USDC stablecoins. And then they launched small business banking on top of that for businesses to do all their banking using USDC as well. And anytime the business makes a payment, they just do the conversion there in real time back to pesos. And so a lot of users have now signed up with them as a banking product provider or a substitute for banking rather than a crypto exchange. And that wouldn't be possible without stablecoins. So I think you'll see a lot more interesting use cases like that, where you're just building things that like would be really difficult to do if you're building them on conventional financial rails.
It's super interesting. And I think several of kind of the companies that have evolved over the past several years are providing services to folks that are either underbanked or underserved. I think you said that in Brazil, and it sounds like in this crypto use case, it is kind of providing that type of service. And looking at your background at Funding Circle, providing loans to small businesses, and then Pedal, like it seems like you've got a background and an interest in helping provide financial services to maybe people with unequal opportunities or fewer opportunities on the banking side. Is that something you've been passionate about, and like does that drive a lot of your decisioning and kind of the companies you work with and your investments? Like, is that a financial opportunity, or is that just an area of interest?
It's a really good question, and I think that you're poking at something that's probably true for a lot of fintech people. The reason I got into fintech to begin with was because I was really interested in understanding how you could use technology to broaden access to financial products for people who were conventionally shut out, or make it easier for them to use financial products. And so you'll hear a lot of companies talk about democratization of financial services, which basically just boils down to how do we get the same products that richer or more connected consumers have access to in the hands of everyone else. And that's what I was so interested in to begin with. And I think a lot of people enter fintech for that reason. But it's the kind of thing like, picking up a sport or picking up an instrument. When you start, you have one idea of what's possible and what you're going to do. And then the more and more you learn, the more you realize, like, one, what you really don't know. And, two, that there are all these small nuances that you didn't really understand or appreciate before, that, make the practice totally different. And so the deeper I've gone into fintech over the last 13 years, the more I care about just like the nerdiest, like most niche stuff. I'll see a company like Embed, which we invested in, building a new settlement and clearing infrastructure to underlie stock exchanges so that you can allow brokerages to settle in real time. And max 1,000 people in the world should actually care about this. Like, nobody should really care about how this works. But here's this founder super passionate about this, and I've been spending so much time in fintech. I'm like, wow, that's really cool. That's really different. Well, I would never show up to dinner and start a conversation talking about that, because people will be like, please leave. And so you start out thinking about how fintech is going to, solve poverty and reduce inequality and change the world. And then you get really niche and you see that there are all these small opportunities where if you actually just improve something that seems really, really marginal, it'll have really, really big ramifications across the ecosystem elsewhere. And I think there's a combination of that and being a little bit disillusioned with the products that are built around democratization and around improving circumstances, where we get pitched all the time on somebody who says, I want to build a financial education app, or I want to build a better budgeting app, or a better, we call them PFMs, personal financial manager. And that's a great idea, but there are a lot of reasons. It's been tried so many times, and there are a lot of reasons why that product has kind of run into obstacles in the past. A lot of those products end up being ads products, basically, where it's like, I can't really make money on selling this, and so I'm just going to upsell by referring into credit cards or referring into loans or banking or other providers. And so when you build that product, you start to appreciate, oh, okay, actually, this is why this doesn't exist yet, and there's an underlying structural issue, and maybe it's really hard for people to earn interest on their bank balances, and so actually that's a way more interesting thing for us to build than a budgeting app. People are paying really high rates on their credit cards because it's really hard for people who are younger or newer or lower earning to get access to credit at reasonable terms. So I don't want to build a budgeting app anymore. I'm just going to go to the structural issue underlying that and build a credit card for people that has a lower rate, because I can underwrite you better than Capital One or conventional credit card providers can. Then you try to build that credit card product, and you're like, wait, what's actually broken is credit scoring. And so I'm going to go a layer deeper and fix credit scoring and build a new credit bureau, because that's really the structural issue. And then you go a layer deeper and you say, wait, the reason credit reporting is broken is because people's personal data and information isn't online. And so credit bureaus can't really make an assessment for how likely you are to pay back a credit card loan. And that's why people are getting charged so much. So I'm going to go a layer deeper and build an identity solution for people to have a wallet with all of their information online. It's this is one example of you started at the surface layer problem where you're like, this is really obvious, I'm going to solve this. And then the deeper you go, the more you realize that there are these very hairy structural problems. And so that's how you end up like me 13 years in, where I am just deep in the weeds on something that 1,000 people max in the world should care about, and nobody else really does. but like it's so cool if you think, okay, here's somebody who's actually going to build a new version of this for the first time.
And I think you keep underestimating that you've now got 107,000 people that care about this.
Yeah, and I love it. It's just great to connect with so many people in the community, and it's great to meet other nerds who are nerds about the same thing you are.
Yeah. Well, you mentioned the ads piece, and obviously just kind of given our backgrounds, we definitely have noticed, there's a couple of things. But one, like kind of in like traditional sort of ad tech, there's this like concept that like payments are the new cookies. And that's why you see like Facebook and Shopify and Amazon using all that financial data for ads targeting.
Mm-hmm.
But then the kind of more recent trend that we've seen is that like these financial services are just becoming ad networks themselves. Chase rolled out a new set of ad products, and we have friends from Snapchat who work at Block, like working on ads products. It's like everyone's going to do it. What's your take on that? Do you see that as a good thing, and maybe as a way to like drive down costs for consumers, or do you look at it as like a distraction for a lot of these kind of services?
It's a really good question, and I'll probably answer that two ways. The reality is you see a lot of fintech companies who can't figure out how to monetize their products, and so they go into ads, and usually that's a little bit of a band-aid solution, and they're saying, well, we can't charge people because nobody will pay for this, and we can't monetize transactions, or we can't lend to them, and so we're just going to set up referral campaigns, and put in third-party ads. And usually that's not a great business expansion, though there are some publicly listed companies that have made entire businesses off of that. What I think is more interesting is if you like break down the fundamentals of what advertising businesses are and what financial services businesses are, you have really similar user needs being resolved. Ads are basically just a way of putting the right contextual information in front of the right person at the right time and saying, hey, this is actually a product that can make your life better for whatever reason. And then, clipping a little bit of a commission on behalf of the product provider when somebody actually takes them up on the offer. Similarly, financial services are just a way of putting money in the right place at the right time to facilitate a transaction. And so payments and ads obviously go really well together, because you're basically just providing like small but continuous improvements in efficiency and efficacy in people's lives. And so this is like a very like philosophical way of starting with answering the question, but there's been a big push in financial services and in advertising towards user privacy. And you have GDPR and CCPA and a lot of privacy regulations where people don't want to be tracked and they don't want their data resold. And that to me has always been a little bit weird, because I love having a very personalized internet experience. I love navigating between different services and having contextualized information come up in front of me that algorithms know is going to actually be relevant to me. And so if I see a targeted ad where the targeted ad has something that I actually want, I'm like, this is great. Like, it's way better than having an untargeted ad, like somebody trying to sell me an F-150 and I live in Brooklyn, online. And similarly, like with financial services, if I'm going to the like checkout to pay for my coffee and I like put my phone on the register, I want my phone to know, hey, we're going to pull up the wallet, we're going to use the main credit card that you use to buy coffee, and we're going to actually select like the card that like gets the best points at this particular coffee shop. And all that happens when I tap to pay. And I don't have to do any of that sorting myself. And so payments at companies like Block, which offers Square and Cash App, and ads at companies like Snap or where I used to work at Google, fill similar functions where you're basically just trying to make it easier for people to navigate their lives effectively, with better products and with better payments. And so I think they really work hand in hand with each other. And so when you see JP Morgan saying like, hey, we have all this data on like what people are actually spending money on, and we can use it to put the products they love in front of them and take a commission, it's not that different from Square saying, hey, we're going to go to merchants and allow merchants to take any form of payment really easily using nothing but a phone, like at a stand in the middle of nowhere, and we're going to take a small commission on their ability to collect payment. Like these products end up really looking similar when you break them down to kind of their core fundamentals.
Going one layer deeper into there, obviously, anyone who listens to this podcast understands kind of the nuance of like the AI driven and machine learning driven algorithms of Facebook and Google to deliver a lot of those ads and contextual experience that you're talking about. But maybe less understood is like how are financial institutions or fintech companies starting to think about AI or more advanced machine learning into doing some of the things that you're talking about, or maybe other things that are just more consumer oriented around their core business? Like, is that something that's happening that consumers should be aware of, or like are these institutions just too far behind?
Oh yeah, no, everybody cares about AI. Every single industry, every single CEO cares about AI. And if they're smart, they're talking about it on earnings calls if they're publicly listed. I mean, I couldn't get out of Thanksgiving dinner without having people start talking about AI last year. That's definitely the hot topic. And I think that every company will, over time, leverage machine learning and AI to improve their product experience. And that'll happen, like very generally happen in kind of two ways. One is you'll take a lot of work that used to be human work and you will default to an algorithm that can do the work more effectively. And then the second way is you'll find ways to use machine learning or AI to do things that honestly you couldn't have done before using people, to pull out rich insights, to find connections between what seemed like disparate pieces of information. And so financial services, just like advertising, is a great place to apply that, because at the end of the day, what you want is smart products that recognize exactly who is trying to use them and what they're trying to do. And so you eliminate a lot of the friction points in financial services. And a lot of how companies make money in financial services is by manually reducing friction, and sometimes even introducing friction. And so I think AI is going to be disruptive to a lot of business models in that you'll enable companies to provide products a lot more seamlessly in a way that it's not really possible to charge for that friction anymore. And so overall costs of a lot of products will reduce in churn, and that will end up democratizing products a lot more than like any one app can do.
Yeah, I mean, it's the more you kind of talk about this stuff, it is funny you gave that example earlier, but it's like a rabbit hole. Every piece kind of leads to something a little deeper, a little deeper, a little deeper. That's going to have just like profound effects across what we talk about, right? The digital economy, but also just society as a whole. But Nik, we want to be conscious of your time. We're super appreciative you joined us today and kind of talked through and walked us through everything. For listeners that are interested, where can they find more about the Fintech Fund? Where can they subscribe to the newsletter or follow you?
If anybody's interested, I'd always love to rap more on fintech, and you can find me at thisweekinfintech.com and thefintechfund.com.
Awesome. Well, Nik, thank you so much for joining us today. We'll hope to have you back in the future.
Yeah, you guys are great. Thanks for having me.
Thanks, Nick.